nothing like a good deep clean to get everything nice and tidy. And sometimes a cash out refinance could even help you tidy up your financial plans. Welcome to the Red Desk. Today we're talking about cash out refinancing, or that special kind of refinancing that involves equity. Have you thought about your equity lately? It's actually something you can tap into for big expenses like house renovations, consolidating debt, and even paying off student loans. Of course, you can't just cash out and call it a day. It's not always the best option for everyone. But by the end of this video, I promise you'll know the ins and outs of cash out refinances. Let's go. With a cash out refinance, you borrow more than you owe on your mortgage and pocket the difference. The money you're pocketing is all thanks to equity. Equity is the amount of your home's value that you actually own. It's the difference between what you owe on your mortgage and what your home is currently worth. It can increase in two ways: when you make your regular mortgage payments and if your home's market value increases. Here's an example of how a cash out refinance works. Say that you bought a home for $200,000 and you've paid off $60,000. That means you owe $140,000. Let's also say that you want to make $20,000 worth of renovations. With a cash out refinance, you could start a new mortgage that's $160,000. So the original $140,000 plus the $20,000 you needed. A few days after closing, you get that $20,000 in cash. Cool, right? If you need money for repairs or renovations, a cash out refinance is almost always cheaper than running up credit cards. And it's easier to justify because you're investing that money right back into your house, which increases its value. You can also use a cash out refinance to consolidate your debt. The only downside to consolidating your debt is extending the length of time you're paying off that debt. But again, if you aren't on track to pay it off at your current, likely high interest rate anyway, it's better to roll it into your refinance loan and just focus on a single payment at a lower rate. When it comes to investments, time and compound interest are your friends. So depending on the market, it can make financial sense to free up some of your equity and put it toward your retirement or a college fund. While all that is true, here are some things to remember. Just like when you buy a home, you'll pay closing costs when you refinance. This is usually 2% to 6% of the loan, so make sure you are ready for that. Refinancing also takes time, and even after you close, you have to wait 3 to 5 days. So if there's a super tight deadline you're working under, it may not be the move. Your mortgage payments also usually go up because you're borrowing more money than you were before. This isn't always true if interest rates are lower, but it's something to watch out for. And finally, just like the first time you got your home loan, your lender will require another appraisal, and you can't borrow more than what the house is appraised for. The bottom line is that if you have a lot of mortgage payments left and interest rates are significantly higher than your existing loan, then a cash out refinance probably won't make sense for you. You might even consider a home equity loan. But if the interest rate for the refinance is lower than the debt you currently have, or if you don't mind paying a bit more on your remaining debt to get those projects done or bills paid faster, then it could make sense. You just gotta do the math. Need help crunching the numbers? Check out the Rocket Mortgage Refinancing Calculator to see what makes sense for you. Until next time, Red Desk out. Thanks for checking us out. If you'd like to see more videos just like this, you know what to do. Click right here. And as always, like and subscribe. See you next time.